Hi, welcome back to the channel. My name is Dave, and today we're talking about QQQ and selling options against this ETF for income. So I've done a couple videos previously on SPY and the pattern that I like to follow. So I'll link that up above and down below. It might be a good reference to look back on. And I've also talked about QYLD on this channel, which is basically selling at the money covered calls against QQQ. So that's another video you can watch, linked up above and down below, as a point of reference, because we're entering a crazy time right now, right? We've had Thursday and Friday, we're a mess in the markets. Everything's getting corrected. This week we have earnings coming out. We have rising interest rates, all kinds of things. So is it a good time to be doing this? Well, we'll try to kind of answer that question. I've got some examples and we'll talk through all of it. So if that is what you're looking for, please stick around. So before we jump into the Qs directly, let's talk about earnings this week, because these are the top holdings in the Qs, pretty much the majority of them, right? When we're talking about Coca-Cola, Alphabet, Microsoft, Visa, UPS, Boeing, Meta, PayPal, Qualcomm, Amazon, all reporting this week. So that's going to have a huge impact on the Qs. So just be aware, it happens once a quarter. When these earnings come out, they're all compacted into a couple weeks. That's going to give a lot of volatility to the Qs. Now, a lot of people like to trade options against the Qs. It's a very liquid ETF. It's easy to trade those options. Those bid and ask spreads are going to be really nice and tight. Lots of expiration dates. So people in general like to trade options against the Qs versus a similar product like VOO. So people jump in here and trade options against this. Now, if we look at the top 10 holdings right now, you're going to see Apple, Microsoft, Amazon, Tesla, Nvidia, Google, Facebook, Broadcom, and Costco. Those are the top 10. So obviously, those are the ones that are going to have the biggest effect. And like we said, earnings for the majority of those are this week. So that can really upset the apple cart and add a lot of volatility and a lot of premium to your option trades with the Qs. And if you're completely unfamiliar with QQQ from Invesco, this is an ETF, a basket of stocks, about 100 or so. And you can see the sector exposure and the industry exposure here. So you're going to have a little diversity, but it's highly focused on the tech sector and a few other stocks that are present within QQQ, versus SPY, which gives you exposure to the whole S&P 500 index. This is just the NASDAQ 100. So when we're talking about SPY and QQQ and we start thinking about volatility, well, your industry exposure here, you're going to have a little bit of IT services, media, beverage. You're going to have a little bit of utilities in the sector and things like that, but it's nowhere near what you're going to see when you're talking about SPY. With SPY, you're going to have a much bigger influence from things like utilities, oil, healthcare, and REITs, which have all performed really well in the first quarter. So that's going to give it more stability and less volatility. You won't find that diversity in QQQ. But overall, the NASDAQ 100 is going to give you a solid group of stocks. These 100 stocks are ones that you should be proud of to have in your portfolio. So it's kind of select. But yeah, the volatility is going to get hit a lot more, and you're going to see the ups and downs a lot more reflected in the Qs than you should see in SPY. Now, if we look at a one-year chart, you're going to see, right, we're kind of back to a 52-week low at this point, especially after Thursday and Friday of this week. But if we zoom out to 2 years, you're still going to see that it's performed really well over the last couple of years. So keep that in mind before you start jumping in and go, oh my gosh, we're at a 52-week low. There's no way it can go lower. It certainly can, and that can be reflected really quickly. Just a couple Thursdays and Fridays like we just had, and boom, we're going to suddenly be looking at something that's at 280, and you're wondering, why did I do this in the first place? So don't think we've hit a bottom yet. I think we could go a lot lower, potentially. So my pattern with QQQ is to sell an out-of-the-money put out about 30 days to collect 1%. And over the course of the year, if I can do this 12 times, I get 12% return. That hits my goal, all right? So if it works out well every time, then it just expires and I'm happy. But of course, we have these big corrections and then it's going to get put to you. But my step 2, I would say, is to avoid assignment if I can. So if I can close it out and capture most of my premium, that's great. Meaning that if it falls maybe even to my strike price or slightly past it and I can close it near expiration and I can roll it out to a lower strike price, well, that's great for me too, because I want to not own it. I want to kind of treat it like a hot potato. Like, you're not going to give that to me. I'm going to push it right back to you. But in the case of assignment, where you're like, okay, well, it's dropped so quickly, so much, and I've lost on the option, I will allow it to be put to me, especially if I feel like market conditions are decent. So the underlying is still the major component of this, but just to walk through the steps, let's say it's now been assigned to me. Now I'm going to turn around and I'm going to sell the covered call at the original strike price that it was put to me, or slightly higher if I can make a little bit more, great. But I want to try to manage that the best way that I can to still collect 1% a month. Now, if it continues to fall, and this will happen at times, well then again, I'm going to sell the out of the money covered call to collect about 1%, and I'm going to manage that position. And what do I mean by managing that position? Well, that's kind of the tricky part. Stock markets tend to crash, we call it a crash, and then they tend to recover over time. So if you do get involved in this crash and it's, your original strike price was, I don't know, let's say 300, it gets assigned and it continues to fall at 280, 270. Well, now I'm going to sell the covered call, let's say 280, for example, where I can collect that 1%. And as it starts to recover, I'm going to have to try to manage that position. But I really don't want to give up on my original basis. I want to try to capture as much of the upside as possible while selling covered calls to generate as much income as possible. So that's a strategy that's worked well for me in the past. But it's not always going to work out because sometimes, it will. QQQs will shoot up. You'll go through an earnings week, for example, and everything will report good earnings and Qs will fly through the roof. So you want to manage that, keep your basis intact the best way you can. So again, just for example, let's say it's at 270 and you sell the 280 call and it climbs quickly to 280. I might even shorten my expiration from 4 weeks to 3 weeks like this, these types of things. So I still want to try to target that 1%, but if it starts getting closer, I'm going to, again, try to close it out and manage it the best way I can to keep as much of the income as possible and my basis intact. That's the goal. And I did spell this strategy out again in that SPY video a little bit more in a little more detail. So you can always go back to reference that as well if you want to watch that one. This is an excellent week to do this kind of a side-by-side comparing of QQQ and SPY because Thursday and Friday were such a disaster. So it's a great way to illustrate it because I actually made some trades on Monday on QQQ and SPY. And that's what I'm going to do now is kind of show a side-by-side comparison of where these are at right now, and you can kind of make fun of me. But it hasn't been a great week for those two trades. Now, I've been showing a calculator on this channel and some people have been asking about it. It's a very simple spreadsheet. You're welcome to download it. I'll have it down below if you want to use it as a guideline. But understand, it's very basic. It's just to illustrate these ideas on this channel. So lots to improve. We really want to, if you want me to get to where I can brag about it, it would take a little bit of work. But right now, the skeleton that it is will be linked down below. So here are two trades that I did this week. One is on SPY and one is on QQQ. I did both of them on Monday for one contract with a 5/18 expiration. And you can see the price here. So we're going to focus on this side because this is QQQ and that's what this video is about. And I'll just point out kind of some of the differences as we compare it to SPY. But yeah, you can see the strike price is 308 here. So that's almost 8.5% that it has to fall from this price to this price in order for it to get put to me. That's the idea. That's the percent from strike. That's what I mean there. Whereas over here, that's one of probably the biggest discrepancies, right? It only has to fall 4.5%. Again, lots more volatility, a lot more stability from all those other S&P 500 stocks that are in the SPY. So you can see the premium collected, and you can see the collateral that is needed. That I have to, if I have to buy this, if it does get assigned, how much I'm going to have to spend to buy those 100 shares. 30 days is what I'm going to hold it for. Same here. And you're going to see the annual return is about 13%, 13.05. So very close. Okay. And then down at the bottom, this is how I kind of evaluate it. Again, this is just to illustration purposes. So if the stock is above the strike, right, essentially the option expires, then I'm going to keep all $333, which is just over 1% and annualized about 13%. So great. If that happens, perfect. Now, the next thing that can obviously happen is the stock price at expiration goes to a certain value. So that's where you can kind of come in here and kind of play with this if you want. So obviously if it expires down here at 324, well, that's above the strike price. So I'll still get my whole amount. And this is actually the price as of this weekend right now. And this is the price over here for SPY as of right now. So you can see it's moved considerably. 12 points, pretty significant for QQQ, and likewise over here. So that's what that means, and you can easily change this. If it drops to 300, the idea is, well, okay, you're going to lose $800 on the stock between this 308 and 300, and which means, I mean, this doesn't really matter too much other than, yes, you're going to lose money. You're going to collect this premium, so you're out $466.69 is probably what I would focus on here. And then it also does a calculation for your break even. So as long as it stays above 304.67, then I'm going to still have some profit, right? So if I put in a meager 305, let's see, it ends up settling down there. Well, then I'm going to make $33.31, meaning once it gets assigned, I turn around and immediately sell it at that 305. Well, then I still would have made $33.31. And that's the whole point when I say, when I'm talking about managing positions and stuff like that, or closing it out if it's close to that price, I would probably close this out if we're getting really close to the expiration date, right? And it's at, I don't know, that we got a 30, let's say 307 for sake of argument. That means I would have lost $100 between the difference here. But I would have still made $233, which is about 9.22%. So I would close that out. Why own it? And then I would turn around and I would sell maybe the, I don't know, the 295 strike price, right, for my next trade. Because that way I can continue to generate money. I don't have to own this, and hopefully I can kind of hit some kind of market bottom at some point where I feel comfortable actually owning it. Because really what this boils down to when we're talking about options is it always boils down to the underlying. And it's really easy to talk about that with stocks, but with ETFs like SPY and QQQ, it's a lot more convoluted because we're talking about the whole market. So it becomes, you got to be thinking the broad market. How do I feel about this going forward? What do I feel about interest rates? How do I feel long term before I'm allowing this to be assigned to me when we're talking about it from an income perspective? So between these two, whether you like SPY or QQQ, as far as that volatility number, I think people tend to look at this and go, oh, wow, I can afford a lot more volatility. I love volatility. That means higher premiums. Like if I want to sell out the money, I'm going to get a higher premium. And that's absolutely true. But I guess, for me, I'm happy trading options against things like Verizon, about the most vanilla stock you can talk about, right? It hardly moves at all and your premiums aren't great. But I don't like to focus on volatility. I like to focus on the underlying. So keep that in mind when you start thinking about these. When you're thinking about SPY and QQQ, what do you feel better about, the total market or the NASDAQ 100? You kind of have the same perspective. But when you think about it with an individual stock, that's still what's going to be the major driver in having success trading options, is that underlying security. Do you like it? Do you want to own it long term? Do you feel like it's at a good price right now to sell a put so that you can collect that income? And then if it does get put to you, you're happy owning it. So we can look on Fidelity right now and talk about these two trades. So as it sits right now, you're going to see these don't look great because May 18th is a long ways away and we're only 1 week into when I sold this, and we've had some bad days. And now we have earnings on all these big tech companies coming up this week that could really upset the apple cart even more. So if you look at my cost basis, I made $450 on this May 18th, 2022 418 put for SPY, and it's already dropped down to $424 about. Okay, so if you just look at the trade here, I made $450. If I wanted to get out of the way of this, it would cost me $870, and I would lose about $420. So I could do that. I can get out of the way, lick my wounds, and fight another day. QQQ, similar setup here, right? Qs are right now at about $325 a share, dropped considerably from where I purchased this, or when I sold this. When I sold this, I made $333, and now it's got a value of about $602 if I wanted to close it, which means I lost about $270. So again, I could get out of the way and just say, hey, I'm going to buy this again at a lower point, try to make that money back. That might be the way to play it. What would you do? So I'm selling puts and calls against SPY and QQQ. I'm doing this for income. I'm trying to generate some additional income this way. And if it does get put to me, I'm going to turn around and again, try to generate income. That's the whole idea behind this. Now, will I get out of the way of this one? Oh, gosh, I wish I would have waited a week, right? Or two. It's not always great to trade across earnings, especially in a market like this. But I am a little bit hopeful for Google and some of these other ones this week coming out with decent earnings. So we'll see how that all impacts it. And I'll let you know and update you on how these trades progress. So that's the tail of the tape. We'll see where we go. So as I mentioned, that calculator that you saw will be down below. Again, just a basic calculator, but you're free to use it as you will and dissect it and let me know what I screwed up. Now, something that a couple other people brought up, and it was a great point, thank you for pointing it out, is Series I bonds are set to top at almost 9% for the first time ever. And you can go get those on treasurydirect.gov. These are government bonds, and right now they're yielding over 7%. And that deal ends, I think, at the end of the month. But you can invest up to $10,000 per, I think, Social Security number, and that's a nice return that is secure. So it's something you might want to check out. And if I get a chance to do it, I'll actually do a video on the whole thing, the process, and how you walk through it to do it, if I get enough time. But we'll see how that all works out. Now, if you have any questions on what we've talked about today, please ask down below. Thanks so much for watching. Have a great night. Take care. Whoop.